The proposal also, as sort of has been in the press recently, killed off the use of bucket companies.
Okay.
So what does that mean, bucket companies? Well, the bucket company is you've got a trust and the trust owns a company and the trust distributes money to the company. And when the company collects the cash and goes and invests it, and at some point in the future, the company releases that cash back out by way of a franked dividend. Very, very common strategy, used a lot for wealth creation purposes in Australia. Lots of small businesses have these. It helps you separate out the entity that holds the wealth from, say, the risky business assets. Okay, so it's very, very common. Now, what's going to happen here is that there's double taxation, effectively. The new rules say that corporates don't get the credit. All right, so what does that mean? So, got my trust pays 30% tax, or the trustee pays 30% tax. That, let's say that distribution went to the bucket company. All right, have $100 as a fully franked dividend. Okay. So let's say we have $100 of income in the trust. The trustee pays $30 in tax, off it goes. $70 cash is paid down to the bucket company. Now, for tax purposes, that's grossed up. So the bucket company now gets $100 of taxable income, $70 of cash. The bucket company then pays tax on the 100. Okay, so it pays 30 cents on the dollar on 100, so $30 in cash goes off to the ATO, leaving it now with $40 in cash. However, it doesn't get a credit for that tax that's already been paid. And so you're effectively ending up with a 60+% effective tax rate in the company. So your $100 cash ended up being $40 cash in the bucket company. And so even if it fully franked the dividends, there'll be a few bucks left of franking credits trapped in that company, which you can never, ever, ever use. So it is effectively double taxation, and it is quite a horrific outcome for structures that have been widely used.